which is an interesting answer, but incorrect. All right, so we've got about 2 minutes here. We'll get started here in 2 minutes. We try to record everything. No promises that it will work, because sometimes it does not. And then also no promises that we'll send it out, because even if we do record it, sometimes the audio is a little garbled. But we're going to get started here. We are recording it, and hopefully if it works out, we'll send it out. If it doesn't, we just won't send it out. So my name is Hubert Centers, and the title of this webinar presentation is How to Risk Only $156.25 to Potentially Make $1,000. So before I get started, I am registered, and number one, it's just the right thing to do. So I'm going to give you a blanket disclaimer to scare the bejesus out of you. So, warning, important notice, no representation is being made that this strategy or any strategy or methodology will generate you any potential profits whatsoever. I like to give a even better analogy or disclaimer here is, heads up, you're probably going to lose all your money. All right? Let me say that again real slowly. Heads up, you're probably going to lose all your money. Trading is hazardous to your wealth if you don't know what you're doing, and it can be hazardous to your wealth if you do know what you're doing. It's probably going to end like a bad country song where your wife is going to hate you, your kids are going to hate you, your dog's going to die, and you're going to lose your truck. So does everybody understand that I'm going to be talking about hypothetical or simulated performance? Past performance is not indicative of future gains. I'm going to show you what I've back tested. I'll show you what I've forward tested, and then I'll also share with you some trades I've also done in my live account. So does everybody understand that this is a dangerous game that we are playing, and you should never trade more money than you can afford to lose? Does everybody understand? I just need a confirmation in text going, yes, I understand, it's dangerous, I could lose my money. Right? Just give me that so that I know we're all on the same playing field here. I am not here to blow smoke up your rear end and tell you that you're going to take $2,000 and turn it into $1 million. Although I'm sure it's been done before, the odds of you doing it is very low. All right. Now, that being said, I'm a huge believer in, studying to make yourself better. So, like I said, my name is Hubert Centers, and this is my no BS approach to trading and investing. And this is going to be a little bit different, but in a good way. We're going to have fun because, heck, this is a stressful business. It's stressful when you're making money, and it's even more stressful when you're losing money. So I'm all about having fun and cutting up and teaching in a style and presenting in a style that's fairly easy to follow. So it'll be an easy presentation. But before I start, let me see where you're at here. How many of you in here I should ask it this way. What do you trade more of? Do you trade more stocks? Do you trade more stocks? Do you trade more options? Do you trade more futures? Or do you trade more Forex? What is the market that you trade the most of? All right, getting a lot of options, a lot of stocks, a lot of options. Not as many futures, more stocks and options. All right, cool. So I know who I'm talking to. A few futures guys. That's interesting. Okay. All right. So if you trade stocks and or options, so one thing I want to tell you is you probably experienced the NASDAQ 3-hour flash freeze, right? Which happened not too long ago. So let's talk a little bit about hedging the proper way. So if you trade stocks or if you trade options, you should always have a small futures account just to hedge your risk in. Okay. What is one of the biggest risks that you have with stocks and options? So let's talk about that. What are some of the biggest risks that you have when you're trading stocks or options or concerns? So I trade everything and anything. If I could make a market in toothpicks or Tic Tacs, I would do it. So black swan events, right? Those are account killers. They go in the opposite direction, right? So if you're in a stock and you're long that stock, and the market gaps down that next day, you kind of get hosed a little bit, right? Same thing if you're in an option and you're wanting price to go up or you're wanting price to go down, and it gaps up, you're kind of hosed in a certain sense, right? So there's a way, since futures markets trade, 23 hours a day, you don't need a massive futures account in order to hedge on some of that risk. So I just want to go through and I trade more futures than I trade anything, but I trade anything and everything that will move. So in this analogy, what I want to talk about is, and that's when the CBOE went out, that's when the NASDAQ went out. So let's talk a little bit about hedging 101 really quickly. So let's pretend that you were long Apple, and you can either be long via AAPL. You could either be long by calls or long by the stock. And let's say that the NASDAQ exchange went down. So the NASDAQ exchange, NASDAQ, let's just say, boom, it just locked up and wouldn't move. So you're long, you need the price action of Apple to go higher in order for you to make money. So when the exchange goes down, let's say that the NASDAQ futures, which is on the CME, which is a different exchange, they went up when the NASDAQ exchange went down. Would you have to do anything if you were long Apple here? AAPL. Would you have to do anything? So no, because if NASDAQ's moving up, your stock will probably go up too. Now, let's start over. Let's start from another angle. So we're going to say you're long Apple, AAPL. You're long. Okay. And then the NASDAQ exchange, NASDAQ, goes down. But the NASDAQ futures, because they're on the CME, they're still working good, okay? Now what happens is this locks up, and then what happens next is the NASDAQ futures go lower. What do you think is going to happen to Apple? Is it going to go higher, or is it probably going to go lower? Right? So if the NASDAQ futures go lower, Apple will probably be pulled to the low side direction if it's a market proxy stock. Then you'll be losing money when this is happening. So what you could do is, if you have a small futures account, and if the CBOE or the NASDAQ exchange, and all exchanges go down from time to time, that's the same reason, like if you have a futures account, that's why you'd want to have a small stock or options account too also, so you can hedge this. What you'd want to do is you'd want to short some NASDAQ futures. So that way you'd be making money as the NASDAQ futures are going down. You'd be making more money, but you'd be losing money on your Apple position. Does that make sense? Now, it's never going to be an equal 1-to-1. What you're going to do is you're going to either decrease the amount of money that you lose, or you'll be slightly positive, but it's never going to be a 1-to-1 ratio, because you either short too much stuff or not short enough stuff. But it will be better than just naked, not having any hedge at all. Okay, so hopefully that makes sense. So I'm also a huge believer in the more successful people and you get around with, no matter what the endeavor, some of that stuff's just going to rub off on you. So I was born and raised in rural Eastern Kentucky around coal mines and stuff. Pretty much was raised dirt poor, ended up working my tail off. And now I would say I have a degree of success where now, if I want to, I can kind of travel around the world and give business and financial advice to Paula and Branson and stuff like that. This is a funny photo. She's actually about 6 inches shorter than that, because she's got 6-inch heels in on this photo that we were doing at the office. And then Branson, nice guy. Me and him both suffer from dyslexia, which is interesting. We've had a conversation about that. That's pretty funny. You can see here, I'm the big guy in the photo. That's 1, 2, 3 chins. Here I'm losing a few of the chins. I never wear this type of stuff unless it's for like a stupid photo shoot that people just say, hey, you got to wear a suit and tie. And I'm like, that makes no sense at all. Right now I'm in a pair of jeans, a pair of boots, and just like a fleece shirt. That's it. That's just how I trade at the office, because I'm not really in front of people, so I don't have to dress up if I don't want to. Now, this is my office. These are 24-inch LCD screens. I've got 6 of them on this one PC, and the microphone that's in front of my face right now is that microphone. So, and that's all hooked up on PC. But in this office, I think I'm surrounded by about 20 different monitors, and we've got whiteboards up on we've got whole walls are just whiteboards. We use the whiteboard paint, and then it's kind of weird. When I was a kid, I grew up dirt poor, and how you get into my office now is by a bookcase, because when I grew up, I always watched a lot of Ghost of Mr. Chicken and Scooby-Doo and stuff like that, and I was like, man, if I ever make enough money and if I'm ever successful enough, I'm going to build bookcases are going to be doors to my office, and I'm going to have secret passageways and stuff from room to room and stuff, which is pretty cool. So I've got multiple secret doors in the house that my wife thinks is very childish, which I don't really care because I always wanted it, so I'm like, I'm doing it anyway. So in order to get in my office, there's this little book. There's a bookcase like this, and then there's a little book that you can pull, or you can press this electronic button, and then the door slides open, and then inside there's about a 1,500 square foot office that I work in every day at my house. If you do study successful people and you hang around them, a lot of that stuff, I believe, you will actually rub off on you if you're willing to take advantage of what they're trying to share with you. All right. So congratulations, you're in the right place at the right time. Here's why. I'm going to show you how to do this trade that I was talking about, like how to risk $156 to potentially make 1,000. So first, let's do some quick math. So in this trade setup, we are going to pretend that we're going to do 10 trades in a row, okay? And this trade only works 41.3% of the time, where you're going to risk $156 to potentially make $1,000, okay? So the first question I want to ask you, are you willing to do that trade if it only works 41.3% of the time? I got one yes. Any more? So I got one trader in here. Oh, I got two. Okay, all right. Go to two traders. Any more? There we go. Depends. Really? Yes, but only twice. That's pretty funny. So if you know you're going to risk $156 to potentially make 1,000, and out of 10 trades, it's only going to be right 41% of the time. Let's do the math here. So you're going to have 6 losers out of 10. Let's just say that it goes loser, 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 loser. So you're going to lose $936, okay? And heads up, the answer to the question is yes, I would do it every day that ends in Y is the proper answer if you're a trader. And you're only going to win 4 trades out of 10, all right? And it would be nice if the winners and the losers all happened at the same time, but they don't, right? They're all mixed up in the sequence of trades that you take. So you're going to make 4,000. So now you take 936 from your losses, you minus 4,000. So you're going to come out at the end of the week and you're going to have $3,064 if we did 10 trades in that week. Now, would you do that consistently over and over, even if you knew you had to do some deposits on these 6 trades? Deposit, 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 deposit. Answer is yes, you would. And if the answer is no, you wouldn't, because the success ratio is low, then you really don't really understand trading. Like if now if I told you there's a trade, like I could show you a trade that works 92% of the time. And here's what you do. You buy something with no stop and a 2-cent target. It's going to work 92% of the time, but you're going to absolutely make no money whatsoever. And chances are on that big stop loss where you never have one, it's going to just destroy you. So let's say it's worse. Let's say that we're going to say we're only going to go 3 times out of 10 on the success ratio. We're going to say we had 7 losers times 156 equals 1,092. Okay, easy math so far. And then we're going to have 3 winners, 3 successful, good, profitable trades. Even in Kentucky, 3 times 1,000 is 3,000. So we're going to come out, let's say if we did these 10 trades in the span of, 5 days, that'd be for a week. All right. Then we would come out with 1908. So now, would you still do that trade would you do it if you had the potential to make 3,064 or if you had the potential to do 1908? So even if it's a 30% win-loss ratio, it's the amount of money that you're risking as opposed to the amount of money that you're making. It's the risk-to-reward ratio that is the most important thing. Now, how many times do we have to do this trade if we do a risk-to-reward trade like this? If we're risking 156 to potentially make $1,000, how many times do we have to do this trade in order for it to break even? What would be considered a break even on this trade? A success ratio, in other words. What would be the win ratio for a break even trade on this? And we'll just say we're doing 10 trades in a row. So it really only needs to happen 1 time out of 10. If it happens 2 times out of 10, you're pretty profitable. If it happens 3 times out of 10, you're not going to be mad at anybody. And if it happens 4 times out of 10, you're going to love it. All right? So next question, what stage of trading are you in right now as a trader? Are you in the stage where you've learned how to lose massive amounts of money? Stage 1. Then after you get from that stage, then you usually go to, you learn how to lose a little bit of money. And when I say a little bit of money, it works like this. So the first stage is you learn how to lose just massive amounts of money consistently. In other words, you're very effective at burning cash. And then you learn how to lose little bits of money, and you're like, okay, I'm just going to take small losses because this is crazy. These big losses are eating me alive. And then stage three is where you learn how to make a lot of money and then give most of it back, or make a little bit of money and then give most of that back. So you end up treading water. Stage 4 would be where you start consistently making a good cash flow, and you're having big winners, little losers, big winners, little losers, big winners, little losers, and then making a killing is asterisk because I'm registered and I don't know what a killing is for you. And heads up, as traders, we're always trying to learn and get better and make more and more money. So I don't know what a killing is to you. I don't know if it's $2 a day, $200 a day, $2,000 a day, or $20,000 a day, or $200,000 a day. I just don't know what a killing is to you. So what stage are you in right now? Are you in stage 1? Are you in stage 2? Are you in stage 3? Are you in stage 4? Or are you in stage 5? So most people that I help out are in stage 3, and I'm trying to get them to stage 4. All right. So this trade is actually designed to help you go from stage 3 to stage 4. And the reason you're going to do this is because you're going to hold on to a winner longer, and you're going to cut the little losers loose with a very small amount of risk. And then you're going to get another big gain. And then a series of small losses, and then another big gain. So let's dig into that. Now, before we do that, I need to see what type of style you are. What style is your trading methodology? Are you the type of person that has a big old loss followed by a series of wins, small winners, okay? And then you're followed again by a series of a big loss followed by some series of little winners. So that's style A. Or are you like this? Are you big winner, big gain, little loser, little loser, little loser, little loser, little loser, little loser, big O gain, little loser, little loser, little loser, little loser, little loser, big O gain? Or do you suffer from this style where it's big loss, little loss, little loss, little loss, big loss, little loss, little loss, little loss? Where are you right now? Are you A, are you B, or are you C? So I'm more B than anything. All right. So if you're A, we want to try to change this. We want to flip you upside down in your head. I want to take you from taking massive losses to I want to have you have some massive gains and a bunch of little losses. Massive gain, bunch of little losses. So I'm going to try to convert you from style A to style B all in one webinar. Hopefully you're not style C. If you're style C, I can't help you much. Just because you have to go through stage 1 and 2 before I can take you from stage 3 up to stage 4. And it's not to say I can't help you. This webinar, you're probably not going to do the trade correctly. You're not going to follow the rules. You're probably going to jump out of it too early. You're going to premature take your profits, and it's just something that's harder to teach until you get to stage 3 because you got to get punched in the face a little bit first. All right, so I got a short story about the pot roast. And it's a good analogy about how stuff gets passed down. So let's talk about that. So my wife's name is Lisa, and Lisa invites Kelly and her husband over to dinner, and Lisa starts making the pot roast, and Kelly's helping her. And what Lisa does is she gets some carrots and potatoes, and somebody asked, what about the meat and potatoes of this presentation? Well, here's the meat, and then here's the potatoes. So there you go. And then she puts some salt and pepper, some garlic, a little bit of thyme, cuts the ends off the pot roast, and then puts the pot roast in the oven. And then Kelly asked Lisa, like, why did you cut the end off of the pot roast? And Lisa goes, that's how my mom taught me how to make pot roast. That's how she's done it, and that's how I do it. She goes, okay. So Lisa and her mom go to their grandmother's house, and actually Lisa goes to her mom's house first, and she goes, Mom, why did we cut the ends off the pot roast? She goes, honey, I don't know. That's how Grandma told me how to make it. Let's go over and ask Grandma. So they go over to Grandma, and Grandma gives them the same spiel that Lisa gave Kelly, like, oh, the recipe for pot roast is carrots and potato, garlic, salt, pepper, little thyme. Then you cut, here's the pot roast right here. You cut the ends off the pot roast. Here's the pan. Then you put the pot roast in the pan, and then you take the pan and put it in the oven, okay? And then there's like, that's the part we don't understand. Why are we cutting the ends off the pot roast right here? And she's like, oh, honey, back in the day, I only had one pan. The pot roast wouldn't fit in the pan, so I had to trim the edges off the pot roast in order to make it fit. So you got to ask yourself, you've probably been trading a long time. When you asked yourself, what is the best market to trade, what answer did you come up with? Who answered you? And probably what you came up with is, you should trade the stock market. You should try options. If you're going to trade futures, you might want to try the S&P E-minis. And then what happens to you is you want to go where most of the volume's at because that's where most people trade. And then you start going, okay, that sounds about right. Let's do that. and then you end up trading, and then you end up trading them, you get chopped up, and then you start asking yourself, like, I don't understand this. What's wrong with me? Why can't I do this? I'm getting chopped up. I'm smart. I'm successful, but I just can't do this. This is just too dang hard. It's got to be rigged. So there's nothing wrong with trusting people, but what I would say is you always need to verify what they tell you. That goes for me too. Like, you can trust me, and I have no problems with that. That's the way I live my life. I'll trust just about anybody, but I'll verify what they tell me. So the bad news is you have been betrayed. Now, I don't mean that somebody has royally screwed you over. What they've done is they've just given you some misinformation. So it's not your fault that you're probably losing money. It's because you've been lied to. The question is, who are they? Well, they are other traders, the media, investors, and it's passed down from generation to generation to generation. Did you test if this market physically matches your personality and if it's the best market to trade? So some people are really good stock traders. Some people are better options trader. Some people are better futures trader. Some people love to trade Google. Some people would rather trade JCPenney. And then some people would rather trade crude oil, which is a crazy market, or natural gas, as opposed to a calmer market would be like gold or bonds. So did you test it, or did you just believe it? So remember, the analogy is always trust but verify. It's a good way to lead your life as a trader. So true or false, if you can trade, do you think you should be able to trade any market? So give me a true or false in the chat box. True or false? Do you believe this statement? If you can trade any market. True or false? Okay. I'll give you a little countdown here. All right, I'm getting lots of trues, a few falses. So I would say it's about 80-20 true false. So I would say that's probably true. If you can trade, you should be able to trade any market, but, and this is a big but, it's going to be a lot easier if you trade something that matches your trading style and your personality. Does that make sense? Like if I threw you in natural gas and natural gas was crazy, it might freak you out a little bit. So if you don't match your trading style to the right market, it's going to be very painful and very frustrating. Trading the wrong market or the wrong style for you is like hitting yourself in the head with a hammer. It's going to feel great once you stop. All right, so think about this statement. What's wrong with trading better, faster? What's wrong with it? Is there anything wrong with trading better, faster? I'm going to get a quick drink here while you answer that. All right. So I don't think there is a shortcut to long-term success, but I do think you can shortcut your learning curve. Okay. There's nothing wrong with getting better at trading faster, and there's a couple of different ways you can do it. And one of the best ways, in my opinion, to do it is find some market that you really, really are in sync with. Okay. So let's go through how to pick the best market for you to trade. Now, there's a couple of things that you have to know first and foremost, because this is kind of a loaded presentation, right? Nothing that you don't already know here. I have to tell you like how I'm wired up as a trader, and then hopefully it'll sync up with you. So you first have to decide, are you a trend trader? Well, first let's do this. I'm trying to see. I actually got this longer in my presentation. So let's start with the average true range. On the average true range, does everyone know what the average true range stands for? Who does not? And I'll explain it really quickly. So average true, all right, so we're getting a few people. So an average true range stands for, an ATR means average true range. So if a market opens up here and then closes here, this is a good common sense way of thinking. That's the range for the day. If we're going to use a 14 period average true range, that's going to look back 14 bars, it's going to add the highs and the lows, divide it by 14, it's going to come out with a number. So it's going to tell you, like, for the past 14 days, the Dow moved 93 points. It's times $5, so we're going to make or lose $465. Range of the day, 14 days average. Yeah. So that's what we're going to do. So the Dow does that. The S&P moves $10. It's $50 a point. You're going to make or lose $515 a day. NASDAQ moves 25 points. It's worth $20 a point. You're going to make or lose $518 a day. The Russell moves almost 10, 9.9. It's $100. You're going to make or lose $990 a day. The 30-year bond moves a little over a point. It's $1,000 a point. You're going to make or lose $11.50 in a day. Crude oil it moves $1.83. It's worth $1,000. It's $18.30 plus or minus. That's what you're going to lose, make or lose. Now you can see silver. It's a little crazy. You could make or lose $3,150. Gold, you can make or lose $1,800. Aussie dollar here, make or lose $7.30, and the euro, make or lose $11.25. So based upon this column over here, which one would you want to trade? Just based upon this total over here, which would be your pick if you were going to pick something to trade? Which one would you go for? This one stands out, right? Because you're like, man, I can make or lose $3,000. That's awesome. Let's do that. Only problem with silver is it's crazy. It's a little bit too sketchy because it goes like this right here. It goes run. It'll explode, consolidate, explode, consolidate, explode. It's a little bit too highly leveraged. So I would mark that one off my list because it's a tough nut to crack. Right? High performance bond for SI. Yeah. And then what you're looking at is you're like, okay, well, what about gold? Gold looks good. Gold is not bad. And here's how gold trades. Gold trades, it goes breakaway, consolidate, breakaway, consolidate, breakaway, consolidate, and then it'll pull back. So that's not bad. That's a good trending market to trade. These you kind of want to stay away from, even though a lot of people trade them. They go like this: run, stop, reverse, 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 run, stop, reverse. And then they'll break away just a little bit, fake you out, run, stop, reverse, run, stop, reverse. So bonds also a nice market to trade. Here's how they trade. They go up and then pull back, up and then pull back, up and then pull back, consolidate and then pull back. So when you're looking at a market to trade, you want to pick something that has a good average true range, and it's got to have a good personality. It's got to have a good personality for you to trade. So I'm going to be talking about like why you want to trade bonds and notes. I don't have enough time to talk about notes, so I'm going to teach you how to trade bonds instead. This is all about holding on to a winner longer. Now, we've talked about sprinters and marathoners. So if you're a sprinter trader, you're going to do this. You're going to go run, stop, reverse, run, stop, reverse, run, stop, reverse. Okay? Now, markets that are like this. This is index futures. This is also some stocks. And then on this side of things, there's always some choppiness. Crude oil is like that on a daily basis. Crude oil is kind of crazy. Crude oil will go like this. It'll go run, stop, reverse, break away, consolidate, break away, come back, try to kill you, and then it'll do run, stop, reverse again, and then it'll go back up. So it's a little bit difficult to trade, so you got to be careful with crude oil. So things that tend to be sprinters are the counter trend traders. Counter trend traders, index futures. Index futures tend to be really good counter trend traders like this. Marathon traders would be bonds where you go up, pull back, up, pull back, up, and then pull back. Or gold where it goes explosion, consolidation, explosion, consolidation, explosion, consolidation. That's basically how you look for it. These are the two markets. This is why I'm going to try to talk you into trading some bond futures. And I know there's not a ton of futures traders in here, so I'm going to give you a quick lesson on futures really quick. So I'll skip some of these slides because you don't really need them until we get to the part where it needs. All right. So in futures, on index futures and in bond futures, we trade them by the months, okay? So these are the months that we trade index futures and or bond markets. So it's HMUZ. Now, you can just call it Hey Man You Zipped or Hummus or whatever. H stands for March. So for this year, it would be US would be the bond market. That's the 30-year bond. H would be the month, and 13 would be the year. For June, it would be US M13. For September, it'll be US U and then 13. And for December, it'll be US Z 13. Now, here's how the futures market works. So right now, the market that we're trading is the December contract, which is this symbol, US Z 13. Does everybody understand that? Now, what happens is at the end of in September, the second week in September, we are going to start trading the December contract. In the second week in December, we will start to trade the March contract. And in the second week in March, we will then shift over to the June contract. And then in June, in the second week in June, we will start trading the September contract. That's as complicated as futures gets. All you're going to do is every 3 months, you've got to roll into a different futures contract. So we're trading December right now. It's obviously November, right? We just rolled into November. So we're going to trade the December contract until the second week in December. And then when the second week in December gets here, then we're no longer going to be trading December. We're going to be trading then the USH 14. Does that make sense? Hopefully I'm not confusing you. So that's how futures market works in the bond market. Bonds are not complicated at all, and I'm going to show you a good example of how you can, if you trade the stocks or if you trade options, here's all you really have to know. Does anybody own one of these? This is my rendition of a house. Anybody own one of these? Anybody? All right. Does anyone have a mortgage on one of these? And in the States, you either have most people either do a 10-year, a 15-year, or a 30-year. And I would say most people in America usually do a 30-year, but you should do a 15. It's cheaper. All right. So if your interest rate on your home is going to go up, then all you have to know is then the U.S. bond market will go down. Make sense? If your interest rate on your mortgage goes up, the bond market will in most likelihood go down. Now, the government's been buying a lot of bonds, and bonds have overall been in a massive downtrend, and now they've bounced a little bit. Now they're rolling back over again today. So you really don't know, you don't have to know a ton of just crazy information in order to trade these things. You just need some basic concepts. So this is how they break down. They're open at 6 p.m. every day, and they close the next day at 5 p.m., which basically means they're open 23 hours. So that's plenty of time for you to trade them. Now, the open outcry, which is the pit session, opens up at 8:20 and then closes at 3. This is just the pit session. It's still open electronically, and you're not going to be trading the pit anyway. You're going to be trading the electronic session. So, but there are definitely more traders that are trading from 8:20 to 3 o'clock, just because that's when the pit's open. Here's what it looks like on a quote machine. This is the one that I'm going to be talking about, which is the U.S. This is the 30-year bond. Here's the 10-year note. There's the 5-year note, and there's the 2-year note. There's more volume, obviously, in the 10-year note. I trade a lot of the 30-year just because I like it, because it's got a better tick value. So you can see the start time. It opens up at 6 o'clock. It closes at 5. It's worth $1,000 a point. Now, this is the minimum move. A minimum move is 1/32. So that may confuse you. It may not. That's a fraction. You may remember that from either grade school or high school or college. I don't know if you were a math whiz or not, but every time it moves from 1/32 to 2/32, that's going to make or lose you $31.25. All right. So let's take a look at some of the cautionary times. You need to be talking about, you got to take a look at interest rates, any other major economic news. I use a kind of day for that. Just use this as your calendar. If it's got a little orange star or a little red star on this, then what's going to happen is that means it merits more attention. So this next slide will really kind of show you what we're going to be talking about here for the rest of the webinar. So on TradeStation, not this slide, but the very next one. So here's TradeStation, USH13. Here's Infinity, ZBH13. These are both 30-year bonds. So check with your broker on what symbol they use for the 30-year bond. This is probably the most important slide in the entire presentation, because I'm going to break it down for you and show you exactly how the bond market works. So we're going to pretend that you are long here at 135. Does everybody see this? You're going to be long at 135. That's the price for bonds right now that you got long on. If you go from 135 to 135 and 1/32, you see that tick? How much money did you make if you're long? If you went from 135 to 135 and 2/32, how much money did you make? Anybody? There you go. All right. So Tony's got it right. $31.25. $31.25 less commissions. That's correct. Now, if you go from 135 to 135 in 230 seconds, how much cash do you make? $62.50. Now, if you can remember from our earlier slide, the average true range for bonds was greater than 1 point. So if we go from 135 and we go all the way up here to 136, which is basically a sexy way of saying you held it from 135 and then you go 135, 29, 30 seconds, 135, 30, 30 seconds, 135 and 31, 30 seconds. The next thing that's going to happen is going to be 135 and 32, 30 seconds. That's actually going to be 136. That means you're going to make a full $1,000 on that trade. Does everybody understand how the bonds work now? This will tell you the tick value, the minimum move, how much each little minimum move is, and there's 31 increments in a full point in the bond market. This is what they look like on TradeStation on this side. This is what they look like on Infinity on this side. One broker may represent it to be 131 and 31, 30 seconds, and another broker may do it like this, go 133.12, which means 32, 30 seconds, which just means it's 133 and 12, 30 seconds, 133 and 13, 30 seconds. So it's pretty easy to understand. Just check with your broker. So let's go through the margins on these things. Number one, call your broker. Your broker will always tell you what the intraday and the overnight margins are for his individual institution. Most people will give you about $500 intraday margin on bonds, but I don't recommend you going that low, so be careful. CME website has them too, but those are the minimums because the broker can always ask for more. So it's the minimums that they'll ask for. So the CME may say, this is the minimums, but the broker will tack on more. Overnight margin for the bonds, about $3,300 for the 10-year, $1,490 for the 5-year, $743, and for the 2-year, about $304. Now, let's do a couple little math problems here. If you go long bonds at 9:30 a.m. East Coast time, and you hold it till 4:30, is that overnight margin or intraday margin? Is it overnight or intraday? Intraday, that's right. Now I'm going to give you a little cheat sheet here. These things open up at 6 p.m. East Coast time, and they close at 5 p.m. East Coast time. Okay. Now let's say you at 9:30 you went long, and you held the thing until let's say you held it till 6:30. Is that overnight or intraday? That's right. That's overnight. That's right. So you're going to have to pay more for that trade, or they're going to deposit more out of your account for the holding period. Now, let's say that you initiate a trade at 6:30 p.m. and then you exit it the next day at 3:30 p.m. Is that overnight or is that intraday? That's right. It's intraday. Intraday. Now, let's say you start a trade at 6:30 tonight, and you hold it until 5:30 the next day. Is that overnight or intraday? That's right. That's overnight. So one thing we're going to talk about is holding the bonds for as long as we can without being charged the overnight margin. That way, if you have a smaller account, you can still trade this thing and potentially make more money in your account so you can build it up. So there's a distinct advantage to doing that, and I'm going to talk about that. So now what I'm going to do is I'm going to break right into the meat of the presentation, and I'm going to show you this exact trade setup. So this is called a 30-year reversal trade, and there's 3 common reversals. There is an 8-tick reversal, there is a 12-tick reversal, and then there is a 16-tick reversal. Okay. So what you're going to do is if you've got the bond market and it's slamming down and it's going down, what it will probably do is it will retrace 8 ticks like this right here, and then it'll continue on its merry way. Now, if it doesn't do that, what it'll do is it'll sell off, retrace 12 ticks, and then continue on its merry way. If it doesn't do that, it'll go down, retrace 16 ticks, and then continue on its merry way. Now, I tend to be more of an 8-tick reversal guy because I want to be in the move. So I will either do 8 ticks or I'll do 16 ticks. I usually stay away from 12 ticks, and I would recommend that you just pick one of these at first. Either 1, 2, or 3, whichever one you're comfortable with. This is just how the bonds work. They'll go up, they'll pull back 8 ticks, and then they'll continue. So all you're going to do is look for a new high, pull back 8 ticks, and initiate that trade. So let's go through the rules really quickly. So you don't need that. You just need the chart. Where I went through the math, 4 times out of 10 should net you some good cash. 3 times out of 10 should net you some good cash if all the numbers work good for us, right? So before we get started in the actual rule set, does anybody know what this is, where you initiate a short here and you cover here? Does anybody know what that's called? This little trade right here, where I short something here and then I jump out of it here. Scalp. I guess a scalp's one word for it. I would call that a loss. Okay, so I lost $156 on that trade. Now, if I short this here and then I cover up here, what's that called? It's a losing trade, loss. Let's just do it. Let's just get a big X. This is also a big X, minus 156. Okay, so that's another bad trade. Okay, now at 6 p.m., the bonds got me twice, and I'm sitting there going, okay, bonds, you got me. You got me a couple times. I'll get you tonight. Then what I do is I let the bonds open up at 6 p.m., and then I let them sell off. And then from this bottom low here, I say, okay, if you bounce up 8 ticks, I'm going to short you. I let it bounce up 8 ticks. I short it right here, and then I use a 5-tick reversal, and then I use a 32-tick target. So here you have 1 loss, 2 losses, and then here you have a gain of $1,000. So now what's that come to? If we have a $1,000 gain minus 156 minus 156, what does that come out to be? Somebody whip out the calendar real quick for me. I can probably do it on my, there you go, $688, $688. So not bad out of a string of 3 trades, right? So now let's go through this particular trade setup. So here's your first rule. Rule number 1, follow the daily trend. Okay? And once you follow the daily trend, only trade in that direction. Then, when you trade in that direction, let's say it's down in this case. If down, let it bounce up either 8, 12, or 16 ticks. And like I said, I've already told you, I enjoy the 8 tick more. And then at rule number 4 would be place the trade, 5-tick stop loss, and rule number 5, 32-tick target. So here's the bond market in this example of this slide. The bonds have been climbing. You see where they broke this uptrend line? Now they would be considered in a new downtrend. And this is the day that we're going to initiate this trade, okay? So it sold off like crazy, consolidate, and then sold off like crazy. And I already told you that the bond market trends very well. It doesn't do a lot of this herky-jerky crap. Now, it can from time to time, but usually what it does is uptrend, breaks the uptrend. Now we're going to go in a downtrend. So I just want to do a real quick informal survey here. Are we all on the same page that we believe that bonds are in a downtrend based upon this slide? All right, we're on the same page. Then what we're going to do is, since we already know that bonds are in a daily downtrend, we're going to let them sell off. And every time that they sell off, if they sell off here, we want to short them when they bounce up 8 ticks, right? Well, here at 6 o'clock, I'm going to let them open up. The bond market opens up, goes just a little bit higher, sells off. Here's the low. I'm going to let it bounce up 8 ticks. I'm going to short it right there. I'm going to use a 5-tick stop loss from my entry, which is $156.25. And then I'm going to use a 32-tick target. Make sense? You could have also done it off of this low. You could have let it bounce up 8 ticks if that would have been good. You could have done it from here if that would have been 8 ticks. On this trade, I already got in the trade. I had a 5-tick stop loss and a 32-tick target. Now, any reasons why you think this trade may be profitable for you? Why is this trade probably going to make you more money than other trades? You can do this trade in both the overnight session and the intraday session. In this example, I initiated the trade, almost Looks like 11 o'clock, right? 10 or 11 o'clock. So initiated the trade. The whole time as the market's going down, I'm sitting here in my little bed, right? And I'm just sitting here just burning off Z's. In other words, I'm asleep while this is happening. So I can't jump out of it prematurely. I can't strangle it and move the stock, the trailing stop down too much. I'm either going to lose 5 ticks or I'm going to make 32 ticks. So let's go over the trade one more time. Here you've got the 6 o'clock open. The bond market sells off. We already know it's in a downtrend. So once it puts in a low, I'm going to let it bounce up 8 ticks. So 146, 4/32 is my low. I'm going to let it bounce up to 146 and 12/32. 4 plus 8 is 12. So we're going to short it right here. Now 12 plus 5 is 17. This is our stop. And then our target is 32 ticks right here. All right, this is that trade. Now, I will trail my stop. When I woke up in the morning, the trade was already moving on down, so I was risking 156. At this point, I've locked in $937. I'm like, okay, I'm going to trail the stop down to $375 just in case it bounces up here and takes me out. But in the next 2 ticks, I ended up netting $1,000 on the trade. So it's a pretty easy trade setup. Any questions on the first trade setup? Because I've actually got another one I want to share with you really quick. Any questions on the 8-tick reversal? 8-tick reversal in bonds. They're very easy to do. You can do them intraday. You can do them overnight. Any questions on the first trade setup? And then what we're going to do is, as a bonus here, what I'll do on the end of it, I'll show you some of the ones that you could have done today. And then I'll show you where the bond market is right now. All right, so no questions on bonds. That's awesome. So let's go through one more. So this next trade is called the sneak attack trade, okay? Sneak attack. So you say this works on the 10-year too. It does work on the 10-year, Tony, but you have to use different pullback parameters, stops and targets. Like you can't use a 5-tick as a stop, and you can't use an 8, 12, or 16. You have to, since they trade in 1/64ths, you probably have to double that, okay? All right, so for the next trade, which is called a sneak attack trade, the bond market opens at 8:20 a.m. East Coast time and then closes at 3 o'clock p.m. East Coast time. So what we're going to do is first, are we in an uptrend or a downtrend based upon this chart on the 30-year, on this slide, up or downtrend? So we're in a massive uptrend. It breaks this trend line down, and then now we're in a downtrend. So in this case scenario, we only want to take shorts only. We don't want to do longs. The reason we don't want to do longs is because we like money. The only reason that you would go long on a massive downtrend is because if you hate money. And I know you don't hate money if you're a trader. So let's go through the rules. So point 1, you're going to start at 7:20, and you're going to mark your time start at 7:20. And then you're going to put a mark at 8:20 for your end time. You're going to, between your block of time here from 7:20 to 8:20, you're going to find the low, and then you're going to find the high. Everybody understand step 1? Give me a yes if you understand step 1. From 7:20 to 8:20, you're just going to bracket, say, there's my low, there's my highs. All right. Now what you're going to do is here's what it's got to do. It has to be at least 5 ticks range, but it cannot be any greater than 17 ticks. Okay? So if this range is bigger than 5, we can do it, but it can't be bigger than 17. If it's bigger than 17, you can't do it because you've already got half an average true range on the day, and your likelihood of this working decreased substantially. Now, all we're going to do is we're going to do a simple breakout trade. You can see that we're taking out the high here on this bracket, so we want to get long right here, right? So we're breaking out of this long, or we're breaking out of this bracket. Do we want to go long here? Yes or no? No. Remember, we're in a massive downtrend. So we only want to do shorts. Got it? So what you're going to do is you're going to bracket this trade, put your lines, and go, okay, bonds, if you go up, you go up without me. So then what you do is you just come down here and go, okay, bonds, you got to go down in order for me to short you. Here you can see on this candlestick right there, you had a break of the low of that initial range. So you would short it there. You're going to use a 5-tick stop loss on this trade also. And then what was your range? How do you do your range? Like 145 and 31 30 minus 145 and 21 30. How many ticks is that? And here I've got the math for you down here. Okay. So that's 10 ticks. So is that less than 17 ticks? Yes or no? Answer is yes. That's less than 17. Is it bigger than 5? Yes. Okay, we can do the trade. So now what we're going to do is the range in our block of time, which is going to be 10 ticks, is also going to be our target down here. So we're going to short it here, 5 tick stop loss, 10 tick target. So I'll show you one more time. So here's how it works. This is 720 right here. This is 820 right here. This is our low. These are our highs. Then what we're going to do is, since we're in a massive downtrend, we want to take shorts only. When we break out of that range right here, we're going to short it. We're going to use a 5 tick stop loss, and then we're going to use a 10 tick target right down there. So it's a pretty easy trade. So no trade in the case until it breaks the bottom of the initial range. That is correct. And it has to be at least a 5 tick range and no bigger than 17 ticks. So now I hate calculating this stuff up manually, so I build indicators to make my life easier. I'm not here to sell you indicators at all. But in this case right here, you see where it says short entry right here. This is my short entry. And then right here, this would be my short stop, which would be right here. So my short entry would be on the purple dot, and then my short stop, I could go down, and then there's my short target. Here's another example of a long. So in other words, this is my long entry. This is my long stop, which didn't get stopped out. And then boom, here's my target. Why not make the target ATR from high prior to the entry? Rodney, I just found that this worked out really good. How do you calculate the target? So I'll go back up one. You calculate the target based upon the range from 720 to 820. So if that range is 8 ticks, your target's 8 ticks. If it's 12 ticks, it's 12 ticks. If it's 15 ticks, it's 15 ticks. In this example, that range was 10 ticks, so your target is 10 ticks. All right. So what you got to have is you got to have some really good money management. You got to have some really good entries, and you got to have some really good exits. What that'll do is that'll increase your profits and your confidence, and that's kind of the sweet spot for all traders when you have these three overlapping. So you got to have some good setups. Good setups that go executed will beat the pants off of perfect setups that go unexecuted. Good is good enough. Don't try to filter out all the losers. That is a fool's game and for suckers only. Enjoy the process. Work through it. You're going to have some wins and you're going to have some losses. So I'm going to open it up to questions here. But before I do, I want to make you a special offer. And here it is. It's on the slide right now. If you go to hubertcenters.com/power, then what we'll do is we'll give you the advantage and the opportunity of getting 2 of our classes for about the price of 1/4. Okay, so I'll explain to you what's in this package, and then we're going to take a look at the bonds live on my charting package, and I'll show you this example in a little bit more detail. So the course is called My Favorite Trade Setups right now, and there are 7 modules, and it's 7 hours long. It's online video, and I normally sell it for $197. There's also the Cloud Charting Secrets course, which is the Ichimoku course, #1 selling of its kind. It's usually $197, and I'm going to let you have both of those for $97 total. It's a one-time fee. There is no recurring fee. This is just for the first 100 people. You can also call the office, area code 859-963-3445. Area code 859-963-3445. So that the operators are standing by if you want to call that. I know some people would prefer to call phones, so not a big deal. And that's the number for that. And the website address is hubertcenters.com/power. hubertcenters.com/power. I am going to open it up to questions here on these 2 trade setups, the overnight bond trade and the sneak attack trade. And then we're going to, as soon as I get through all of the questions, I will then go through some bond charts live with you, okay? Now, I want to show you what's in the course that you get. When you click the Add to Cart button, you'll see my ugly face right here. It'll say Add to Cart, get all this for only $97. And then from there, you're going to have Part 1, Part 2, Part 3, Part 4, Part 5, Part 6, and Part 7. Those are all 7 minimum of 8 hours of content on those videos. It's hour 1, 2, 3, 4, 5, 6, and 7. And then I do live trading. This is a recording of a live trading session, and then here is the cloud charting secrets package. So everything is backed by 100% satisfaction guaranteed, no questions asked. If you don't love it, you don't keep it. That's my promise to you. Here is what's in each course. Module 1 is swing trading. I show you how to swing trade stocks and also day trade stocks. And then module 2 is swing trades and day trades. And then you also learn how to do E-mini trades and day trades. Module 4 is gold swing trades and day trades, and then bond swing trades. And then the bonus is the Ichimoku cloud charting secrets. So this is what's in module 1. Favorite ways to scan the markets for swing trades. Best way to scan the markets for day trades. How to filter out the best trades. Now, if you're a stock or an option guy, these trades right here you're really going to enjoy. I call these the 7 horsemen. I'm going to show you 7 stocks that beat earnings 90% of the time. And then there's another 7 stocks that beat earnings 80% of the time. So you're going to have 14 stocks that beat earnings a minimum of 80% of the time. And that's earnings and earnings per share and revenue estimates. So I know how powerful that is for you stocks and options traders, so that you can kind of know, okay, how often does this thing beat earnings? All right. Stock gap plays. I'm going to show you the best way to trade stocks with gaps. We're going to go over gap and goes, and we're going to go over gap and crap trade setups, and that's in module 2. So that's swing and day trades for stocks. Then we're going to talk about index futures, how to trade index futures with gaps, how to do an ambush trade, the 85-115 fade trade, and then the crescendo trade. I'm also going to teach you that. Now, you already have a couple of the trade setups. I just taught them to you now, but this is another trade where I teach you how to risk $600 to potentially make $6,000. That is the Goodnight Gold trade. We also have the Gold Rush trade and the Gold Bug trade. And the 2 that you learned today were these 2, which was the overnight bond trade and the sneak attack trade. So you've already got this trade and this trade in your trader toolbox now, because you just watched this webinar. And what I do is I teach everything else in a step-by-step fashion. I give you the rule set so you know exactly how to handle everything. So that's how it works. Ichimoku is a cloud charting analysis technique. And there's the link for you right there. HubertSenters.com/power. HubertSenters.com/power. And now I'm going to give you the link one more time, and I'm going to bring my TradeStation over and show you what's going on here with TradeStation. Hold on just a second. All right. I'm going to bring over my TradeStation. Nothing else to buy or no other. Nope, nothing else. If you want to, you can take a trial to my membership site, but it is not required whatsoever. There's no other obligation or anything. After you do the checkout, if you want to take a $7 trial for 30 days, you can, but if you don't, just hit no thanks. No big deal. So let's go through bonds really quickly here. So in the bond market, we're going to go at US. There you go. So what would you call this direction on bonds? So I'm gonna break this down on a weekly. What would you think this is on the bond? See how well, and this is, you're actually going to learn how to use Ichimoku Cloud Charting Secrets in the course as a bonus. Everybody's charting platform should have this. So let's take a look and break down the bond market. So here we've got a massive uptrend. We've broke below the cloud. Now we got a massive downtrend, and we're bouncing just a little bit. So now I'm going to make it down to a daily chart. Okay, so now on a daily chart on the bonds, we're in a massive downtrend. We're below the cloud. We're back above the cloud, but do you see this little blue line right here? That's called the lagging line. The lagging line is not above the cloud. Lagging line is not above the cloud, which means this up move is still in question until this blue line gets above that red little ribbon. So for the past 1, 2, 3, 4, 5 days, I've been recommending, hey, time to get short bonds again, okay? So if we're going to get short bonds again, what are the trade setups we can do? We can do an 8-tick reversal, right? Or we can do that sneak attack trade on the downside, not the upside. So let's go over here and take a look at how the sneak attack would have worked today. So the first thing we're going to do is we're going to make sure that we've got it set to the right time. 7:20, that's perfect. So I'm going to teach you the sneak attack. Remember when we were talking about the sneak attack, we were like, okay, it's going to start here. and then it's going to leave, and then it's going to end right here. So from 720 to 820, do you see that? And then what it does is it calculates that for us, and then it goes, okay, we want to take shorts, right? And I'm like, yep, shorts. So then what I know is this is my short entry right here. Do you see that right there? That's my short entry. That's my short stop. Now, the reason I know it's my entry is because it's got a purple dot right there. So I want to short this at 133 and 20-30 seconds right here. Do you see that? You should see that right there. Does everybody see it? And then I'm going to place my stop at 133 and 24-30 seconds. Now, since this range was so small, my target's also going to be small, right? But if I chose to hold it longer, I'd make more money. But that's about a 1-to-1 risk to reward ratio. So that's the sneak attack. Here you can see how the sneak attack worked the day before. Here you can see how it worked the day before that. So that's one trade. Now let's go over here back to the bond market. And I've actually got another indicator that I use to make this a lot easier on me too. And it's called oddly enough, a bond retracement indicator. Let me apply it to the chart really quick. So we've still got it pegged as going down, right, on the bond market. So what I want to do is I'm going to let this thing figure out the lines for me. And then what I'm going to do, and I want to say override direction. I want to say it's -1 to say it's all on a down direction. So then what I do is I try to find a low, and I go, okay, from this low, then I will hold down the control key and go, boom. And from that, what I would do, I hit it too many times. I hit it 2 times. There you go. Let me remove that. There you go. So from this example, if we were using this low, it would have to retrace up 13 ticks. Now I'm going to remove this, and I'm going to say, all right, this is the low on the bond market right here. Now watch. I'm going to zoom this in. What happened? Well, from this low on bonds today, it retraced up 8 ticks, would have stopped you out on an 8 tick, but the 12 tick one worked perfect. This one you would have entered on a 12 tick, and your stop loss would not have been hit, and you're still looking good on this trade. Now, if you don't want to do all that, now you don't have to worry about any of these indicators. I just build the indicators to make my life just a ton easier, so I don't have to do it like this. But you could totally do it like this. You could go, okay, this is the low, 132, 28, 30 seconds. You see that? That's the most recent low we're at right now. And I could just go, okay, that's the low, and then I'll go 1, 2, 3, 4, 5, 6, 7, 8. So if I do that right there, I could place that sell right there at 133, and that would be an 8-tick reversal off of that low. Does that make sense? If you want to do it manually, you can. There's nothing wrong with that at all. Indicators just make my life easy. So what I'm doing here is I would like to get short at 133. I'll risk 5 ticks, and then you can see down here automatically there's my 32-tick target. So I'm going to risk 5 ticks to make 32 ticks. Now, if it retraces on me all the way up there and then I get stopped out, well, then I already get stopped out. But if it comes up there and tags me and rolls back over, then I'll make some money. Now, what would be wrong? What would be wrong with doing this trade right now? Why would I probably not do this trade, even though I'm showing it to you as a demonstration? Why would it be a foolish idea to do this trade right now? Does anybody know? Why would it be foolish? Let's take a look at the video. See how much bonds are down on a daily? How much are they down right now? So that's exactly right, Rodney, because they've already moved one average true range. So it's kind of like saying, it's a bad analogy, but it's kind of like saying that you are betting that it's going to go past its average true range today. And it's not to say that it can't. It definitely can, but you can see it's already moved 1 full point today, right? And what we said is it just moves a little over a point. And if you go from the high to the low, so let's do this. Let's go insert analysis technique. And then I'm going to do this right here. I'm going to do the average true range. Average true range will be right here, all right? And you can see on the bond market, the average true range is about 0.89. So a little bit less than a point over the past 14 days. And we've already moved 30 seconds. So there's not a good chance of it probably going lower. So when that happens, what's going to happen? Well, it's probably going to bounce, right? It's probably going to bounce on me. I'll get filled, and then I'll get stopped out. So what you want to do is, that's why you want to do the 8-tick reversal. But when you get close to one average true range, it's a good idea to cover. And it's also a good idea to not initiate new trades off of those lows that have already been established on the day past the 32-tick range. But you set the target as 32, so aren't these typical overnight trades? They can be intraday or overnight, Tony. You can do both. Like if the bond market was not down a full point and it was rolling over and then it bounced up, I would short it and still hold it overnight. You can do both these trades intraday and overnight. Yeah. So it's better for either overnight or early in the day session, or you can do it late in the session. The bonds don't always move a point in the day. I mean, sometimes they don't move a point at all. Sometimes they'll do a half a point range. All right, so here you go. Here is the link, hubertcenters.com/power, POWER. It's only for the first 100 people. You can call the office, area code 859-963-3445. Any other questions you have, just let me know. Let's see here. So earlier is better. So that's pretty much it for the bonds. I will show you one thing, like the Cloud Charting Secrets class right here that we normally sell for $197. You also get it included as a bonus. I want to show you really quickly, if I can, how powerful Ichimoku is. So give me either a stock that you like to trade or a market, and I'll break it down for you really quickly, and I'll tell you really quickly what it's going to do. So this is Ichimoku, and then I'll give you a couple of examples. If the ATR changes, do you change the target? No, not usually, Rodney. Apple, AAPL, here on Apple. I hear the phone ringing in the background, so if you're calling to order, just leave your message, and the team will get back to you if they don't answer the phone directly. So in Apple here, can you see where the price action crossed below this cloud here? Cloud. So price action below the cloud, that means that it's going to be a sell-off, and Apple's going to go lower. To confirm that, the blue line goes below the cloud. Now, do you see how much damage Apple took after it crossed below that blue ribbon? And now it's got down, and now the lagging line is down. Now, same thing holds true for if you can get the price action back above this cloud, and, you can get the lagging line above the cloud, and you can see then Apple is in a pretty good uptrend, and now the cloud is going to act like it has support. Jumps up, cloud is support. So Apple looks like it's destined to continue higher. The cloud, the cool thing about the cloud indicator, which is on every single platform out there almost, it gives you the present, the past, and the future. So a lot of stuff's real laggy, where this indicator is telling you this is what I did in the past, this is what I'm doing right now, and this is probably what I'm going to do in the present. It's forecasting that it's going to go higher, and if it doesn't go higher, it's saying, hey, this will be support. So that is Apple. CL, I'm actually short a small bucket load of crude oil, and I'll show you exactly why I'm short crude oil. Can anybody guess? It dropped below this cloud, okay? It dropped below this cloud. The lagging line is below the cloud, and now you can see that the price action is just dropping like a stone. So it's doing exactly what it's supposed to do when it's below that cloud. It's just getting sold off like crazy, and I love it because we're short some crude. Short some crude, and that's a good thing. All right. Any more recommendations or requests for charts to be shown? Google, G-O-O-G, really quickly. Google obviously looks pretty good. It's above its cloud. It's above its turning line. It's above the standard line. Google looks pretty good. You do have this ominous gap to deal with, but it looks like it wants to go for 1,050. SPX would be the same thing as ES, so let's just do that. ES looks really good. It's solid. You can see every time that it comes down here and touches the cloud, it bounces off of them like a little mini trampoline, goes boing, boing, boing. Looks good. 1,800 is going to be the target on that one. MCD, Mickey D's. Mickey D's looks like it's a sell. It's in a little bit more of a downtrend, as you can see here. So you got a nice little sell on a downtrend channel here, and since it's below the cloud, that's it's trying to cross. If you can get it to cross the cloud and close above 98 and get this lagging line to cross above 98, it'll be a decent long. But until that happens, you'd have to short that going on right there. LULU, Lululemon. It's a nightmare. Leave it alone. It's sideways. You don't have any advantage at all in that one. Russell APTF is going to be basically the same thing as the S&P. Looks good. Every time it bounces off of the cloud, it takes a nice little jump. Looks good. It's holding its turning line. Its standard line is going to be support at 1078. LVS. LVS is a very bullish stock. Looks really good. It's above the cloud. When it touches the cloud, it bounces. Probably going to go to 68.49 and bounce back up to 70.99. If that does not hold, this will, because it's a really good established support area, and then continue on to about 80. DDD. What is DDD? 3D Systems Corp. Oh, it looks good. That's a good little run there. You can see it's in a valid uptrend. Every time it touches the cloud, it bounces. Bounce, bounce, bounce. Good, looking good. Probably going to go to 80. Looks really, really solid. That is a stud of a stock right there. Is this good for Forex trading? Ichimoku Cloud is wonderful for Forex trading. Let me show you a couple of things in this course that'll probably excite you. And this is just the bonus. So if you take the S&P 500 for the last 5 years and you take 430 of the 500 stocks, that's 86%, it would have returned a 33% return if you take every signal, long and short, on Ichimoku Cloud. Now, if you only take the signals in the direction of the overall daily trend, your return increases to 79% of the time. That's using the 3-day confirmation that I teach in the course. Okay, that's for stocks in the S&P 500 now, and that's across all the stocks. And then you need to use a daily, hourly, 10-minute. Now, if you're talking about Forex, it has been profitable on 29 currencies over the last 10 years if you use daily, hourly, and then 10-minute. Daily, hourly, 10-minute. This is for a little bit longer term time frame. This is for a little bit shorter term time frame. Now, the reason I say that is because when you take the course, this bonus, you can see that if you take an hourly signal on this Ichimoku Cloud, it's good for 3 days of move in the direction that you're trying to go. Yeah, you can use tick charts on Ichimoku. If you use a 10-minute chart, it's good for 2 to 4 hours. If you use a 1-minute chart, it's probably good for 30 minutes. So we go through in detail and show you, like, all right, on this 60-minute chart, this says long, we're going to stay long for 3 days. On a 10-minute chart, this says short, we're going to stay short for the next 2 to 4 hours. So it's a really powerful and simple methodology for technical analysis. It's been the #1 best-selling technical analysis technique in Japan for the past 7 years, if that means anything to you at all. And I will try to get back up here to the offer slide, and then I'm going to turn you loose. And it's right, where did I go? There you go. So it's hubercenters.com/power, $97 one-time fee. First 100 people. Telephone number is area code 859-963-3445. All right, that's it. Good luck. Hope it helps, and I'll see you on the next webinar.